Thank you very much for that introduction, and also like to welcome everybody who is logged in into this seminar. Uh, I'm hoping that in the next hour and a half, I will be able to help in creating a greater awareness with what is now becoming an extremely important component of financial, appraisal of loan applications and renewals of credit. All that affects each one of you. So I think the first thing I would go, what are the multiple challenges? And I think most of you will identify with these. There are marketing issues, there's production capacity issues, there's of course infrastructure constraints, technology constraints because technology is moving so fast. There's competitive elements, competition, too many people producing the same thing, maybe delivering it at cheaper rates. Regulatory concerns about, which again affect your business, limited knowledge of what's happening globally, and of course the main one which we are going to talk about today is the access to finance. Now, most of these problems typically stem from one root cause, and that root cause is the need for additional funds. And I'm sure as we go along, you will tend to identify with some of the points I'm leading into this presentation as typical situations that each one of you face. So I've divided this into multiple sections, and in this first section, we're going to talk about what is credit, what to do if you need credit, what are the documents required for a loan application, what are the types of formal financing options and alternatives that you have available, what is a credit report, what loan officers look for in an application, and the key points for a successful application that converts into a sanction and then a disbursement. Now, some of this might seem a little basic and fundamental as we move into the next few slides, but my request would be that you'll stay with it because it completes the entire presentation and makes it more comprehensive and leads from here into the main topic that we're going to talk about today. So let's start with a very fundamental question: what is credit? Now, unfortunately, this is not interactive as we've introduced. But ideally, I would have asked you guys the question that what is credit? And credit is borrowed money in a very simple form, and it can be in the form of personal loans. You take a home loan, you take a car loan, you take personal loans for expenditures like education, marriages, illness, etc. You also take business loans, and you as MSMEs typically work along the MSME route of taking business loans, which might be a term loan if you want to buy an asset for yourself or for the factory or whatever you're doing, or it might be a pure working capital loan to fund day-to-day requirements of credit and debit that you'd have. Now here I want to introduce one element which I will keep repeating as we go through the session, and that is that your credit card, that piece of plastic that you have, the 3 inches by 2 inches plastic that you have, is an extremely important form of credit. It's probably the most expensive form of credit because we're all paying over 30, 35, 40% sometimes, and we tend to ignore this expense because it gets hidden in the credit report. But I just want to emphasize, and I will keep emphasizing, that the credit card is perhaps one of the most important forms of credit, and there are 2 or 3 key points which I will emphasize right through the session, and this is the first I wanted to. So what do you do when you need credit? First, of course, you decide what type of a loan do you need. Do you need it because you want to bring in long-term money to buy some equipment, or do you want it for working capital? Then you decide the amount that you need, and that's very important because it also depends upon how much you can easily repay. And I think that's very important because sometimes you tend to say, yeah, I'll work it out, I'll pay, but invariably that stretches you, and then that leads to defaults, and then the classic debt trap that you get into. You underestimate the cost of borrowing, you overestimate the possible demand for your products, and therefore you tend to borrow more, build up inventory, and then you find yourself in a little bit of a problem. The next step would then be to decide who do you want to borrow from. So either you could be going to your bank, which you're familiar with and you've been dealing with for many years, or because for whatever reason you're getting better terms or you're not happy with your bank, you might move to another bank. And that's one option you have. Now here's an interesting diagram, which kind of when I saw it the first time, I was quite pleasantly or unpleasantly surprised, which says that 93% of the MSMEs either don't finance, or if they do self-financing. That is, put their own, the owner's capital into the business. And there are only 5% who have borrowed from formal institutions, and probably another 2 or 3% who have borrowed from the informal sector. So that's a very, very large number and a large potential. And today, with expanding opportunities, the Make in India campaign, the e-commerce websites that I'm sure all of you all either either use or supply to, obviously this pie that you have, pie chart of 93% will be not being financed or self-financed, will and necessarily has to change. Now, let's take a minute to look at what are the types of formal financing options that are available. You, of course, have the commercial banks. And then you have what are called the non-banking financial institutions, or the NBFCs, the non-banking financial companies. You have microfinance companies. You have cooperative banks. Then, as you know, recently the Central Bank of India, RBI, has sanctioned licenses to about 8 or 9 new small banks, which are focused on lending to the smaller industry, the smaller individual, the microfinance loans, as they call them. There are limitations on how much the maximum loan they can give. You then have development banks. You have housing finance companies, of course, in case you need to buy a house or build a house or repair a house or extend a house. And then you have regional banks. And then, if those of you who are in the export and import business, you have the export-import banks also. So this is the general categories of possible lenders who you could be thinking of approaching, and that's entirely your decision. But right through this presentation, when I talk about a bank or a lender, it could be any of these depending on who you're dealing with. So what will be your next steps? Like I said, you first select your bank, existing bank or a new one. You then would prepare your documents, get the loan application and your balance sheet and your cash flows and your tax returns and all that stuff ready. You then put your loan application in for processing, and the bank then reviews the same and decides whether to give you a loan or not give you a loan. Some of you have probably gone through this also. Those of you who have already borrowed and in that 5% category of people who have actually borrowed have probably gone through this. So for you, that might be a repetition, but I just think it's important to go through it. So what documents will the bank require from you? There's a whole set of KYC documents. So you have the proof of residence, the proof of identity, etc. Then they come to your financials, and that's where the bank statements come in, the income tax returns come in, and your CA certified financial statements, balance sheet, P&L, etc. Depending on what kind of an entity your MSME is, they would ask for registration papers. So, for example, if you're a partnership firm or a private limited firm, they would want to know the legality of that entity that is now applying for a loan. So here this brings me to the second point, and I'll significantly repeat my emphasis on this as we go forward, which is that especially in the MSME segment, the entity that applies for a loan, whether it's a partnership firm or it's a private limited firm or whether it's you as an individual proprietor, and the individual who owns the firm, which is typically you, there's not much of a difference. You are virtually the owner, you're virtually the person responsible for the growth and the business that the company is doing. It's your ownership, and therefore, from a bank's perspective, they will not only look at the credit worthiness and the application that you make on behalf of the entity, but somewhere along the way, they will also want to check your personal financial standing, your personal repayment history, and your capacity, because the two, that is the entity and you, are very closely linked, if I can use the word. One more thing that the banks, like I said in my previous slide, these are the kind of documents that the banks will collect. But one important document, which is more development of the last decade or so, is that the bank will also obtain a very important document, which is called your credit report. Now, your credit report is a snapshot of your credit history. And of course, we'll discuss more of this in later sections, but I just wanted to introduce it as a document that is very important, which will be sought by the banks from the various organizations that they can take it from. What is a credit report? What does it do? What does it show? Where do they get it from? How does that data go there? All of that we will talk about as we progress in the next sessions. So, coming back, you would complete and submit the loan application. The loan officer would then check your documents. and he would make a decision based on what he would consider as your credit worthiness. Now, credit worthiness is a very long word. It's got 3, 6, 9, 12, 15, 17, 18 words, alphabets in it. But what does it mean? It means two things. Credit worthiness means repayment capacity and repayment willingness. And together they add up to credit worthiness. So it's an assessment of whether you will pay a loan back, but ultimately the bank wants the money back. And if you're going to default, they don't like it. So, that's what they're trying to assess when you are actually applying for a loan and they're reviewing your application. If you are credit worthy, then it's more likely that you will get the loan. It's more likely that you'll get the amount that you're looking for. More likely that you will get better rates on the loan compared to somebody who might be less credit worthy, and of course somebody who is completely uncredit worthy and therefore will not even get the loan. So as I said, credit worthiness is a measure of your repayment capacity and your repayment willingness. So let's look at these two. What is repayment capacity? What is repayment capacity? The repayment capacity, very simplistically put, it tells the bank whether you have the capacity or the resources to pay your loan installments and repay them on time. So where would they find your repayment capacity? Four ways. One, looking at your traditional financial statements, your banks, your cash flows, your balance sheet, your profit and loss, your revenues, your growth, your tax returns, etc. That's one way of determining that whether you have the capacity, the resources, or whatever you call, to service this loan. Now, unfortunately or fortunately, we are in a very competitive world often, and therefore the market condition and the regulatory environment makes a big difference. That's important, and therefore they would also look at the industry you're in. So, for example, if you're in the chemical industry, they would look at any new regulations, export, etc., which will decide whether you might be doing well and you have good intentions, but your industry as a national level or a regional level or even at a local level might be in trouble. Then of course they would have a personal discussion with you. They would check your documents and you ensure that your promoter is reliable. Not very different from what you would do if you were getting into a relationship with a potential supplier of material or a potential buyer and deciding whether to give him credit or not. And then, as I said, the next thing they would do is to pull your credit report. Now, the credit report is being pulled for two purposes. One, it will show how much debt or loans you have currently outstanding and you are servicing. And the second is to see whether those very loans that you have got outstanding and you're servicing, are they being paid on time? Are you paying your loan installments on time? Have you been paying them on time or not? Now, the credit bureau is a new concept to some of you. It's a new concept in India. It's only 10 or 11 years old. And just to put things in perspective, the history of credit bureaus globally is 150 to 160 years old. So we're talking about some serious effort, work, and serious things that have happened in the last 160 years, which have affected this industry. But just to put it in perspective, the Indian credit bureau industry started effectively around the beginning of 2000, the century 2000. So that was repayment capacity. Now let's look at repayment willingness. It tells the bank whether you have the intention to pay. You might have the money, but you might not have the intention. And that is something that is much more subjective. That's much more of a challenge sometimes. Purely because you don't know whether this person is inclined to pay until you give him the money and then you check whether he's paying on time. But the bank over the years with experience has probably built up enough to be able to judge a person when they do their personal discussions. So that's the first thing they do. They look at your personal, they meet you, they talk to you and your team, and they understand that you are willing, as from an intention perspective, to service this loan. And the second way they determine your repayment willingness is again the credit report. So if you remember, as far as repayment capacity was concerned, the credit report was used to ascertain or to decide how much loans you had taken and to see if you had repaid those loans on time. That was for credit repayment capacity. Now for repayment willingness, the question is, have you in the past paid your loans or not? And that's important. Sorry, I just by mistake flipped the slide. So yeah, that's important to know whether you paid your loans in the past Because here is a very important document, which important line, which I'm sure all of you agree with in every which way. Past behavior gives you an idea of your possible future behavior of the person. So typically, in any phase of life, whether it's taking credit or whether it's in your social behavior, in your exams, in any stage of life, your past behavior gives a fairly good idea of your possible future behavior. And I say fairly good because, of course, there are always situations where you might behave differently from what you did in the past. But by and large, past behavior is a very good indicator of possible future behavior. Now, what are the key points? And I think you should remember this. Give the bank both your entity, and I'm calling this your MSME, your entity. This would typically be, as I said, your partnership firm, your proprietary firm, your private limited firm, whatever it might be. So give the bank all the documents, not only the entities, but also yours. If you are a guarantor, if you have a guarantor, please provide his documents. So for example, if you are just starting your business and say if somebody in the family, like your father or someone is going to guarantee the loan, then please provide documents relating to your father, because if he is guaranteeing the loan, the bank will like to know what his details are and what his financials are, and actually it might help you. I think the important point to understand here is that these credit bureaus are here to help. They're actually here to improve the credit judgment of the bank, and therefore enable the bank to take a more informed decision, to give you more money, to give you better terms, and to ask for less collateral. The three pain points. I don't get enough from the bank, I get it at a very high interest rate, and the banks are asking for too much of security. Now the credit bureau precisely is trying to address that, and we'll see how as we go forward. Again, remember, if you remember my mantra, the credit card is an important form of credit. Please do not ignore it. The worst thing you can do to yourself is not pay your credit card installments on time, because the interest rate that you get hit with is significant. So now let's look at credit information, credit reports, and credit scores. Okay, we've now gone to the first bit of what you've applied for a loan, and he's doing all the normal stuff, and he's also putting a credit report. So what is this credit information? Here of a medical situation, right? So for example, if you go to a doctor and say that you have a pain in your shoulder, the typical questions he would ask you is, how long has it been paining? What do you do when it pains? Does it pain in the morning or the evening? Does it pain in winter or summer? Does it pain when you do some physical exercise, like pick up some heavy material, or when you play a game or whatever? Now, the important thing here is to understand what is he trying to do. He is trying to address or solve your medical problem by first understanding what your past is and what is the reason for that. Because each of us can have the same shoulder pain, but for different reasons. Similarly, in the credit information sharing space, let's look at what we will talk about. What is credit information sharing and how does it work? And therefore, what is a credit bureau? Is your information safe to the credit bureaus? And what is that information? Of course, we'll talk about. Who uses credit bureaus? What are the credit bureaus in India? Because that's what affects all of us. And here's a very important component of this section, which is what is not a credit bureau. Because people don't know too much about credit bureaus, they tend to mix them up with other entities that they've heard of. So typically, for example, you might have heard of rating agencies like CRISIL or SNERA and ICRA, CARE, etc. And you would say, acha, credit scoring, credit reporting, credit rating, all the same. Well, it's not the same. So we're going to talk about that difference also sometime towards the latter part of this this particular section. So let's look at this. Let's try and make this actually, a credit report discussion can be very boring. We're not talking about Sachin Tendulkar, we're not talking about films, we're not talking about Amitabh Bachchan, we're talking about a very routine subject. So let's take a case study and say if we can make it a little more relevant, a little more identifiable with your situation. So let's assume a situation where there is a Mr. Mishra who is an entrepreneur and he owns a company called Mishra Company. It's a manufacturing company. There's another gentleman called Mr. Banerjee who's also an entrepreneur and he owns a trading company, and the trading company's name is Banerjee Company. Just two random examples I've taken. Both of them are classified as MSMEs and both apply for a loan to a bank. So both of them have filled out the application form correctly. Both of them given submit the documents, but the credit report of Banerjee company is not okay and therefore they get rejected, whereas Mishra and company is all right and therefore they get approved. So let's see what went wrong. Why did Banerjee and company not get a loan? I hope none of you are ever in that position, but it's possible that you might have been, where you might not get a loan or your bank might turn you down and say your credit report is not good. Now what does that mean and what does it that you need to do to make sure that it is good and therefore you are more in the category of Mishra company rather than in the category of Banerjee company. So let's look at this. What could have gone wrong with Mr. Banerjee's company's credit report? Now this is not Mr. Banerjee's report, it is the report of the MSME that he owns, which is Banerjee company. Either they've delayed loan payments on past loans, or they've been late in paying the credit card bills, or some loan in the past was written off by the bank because Banerjee and company went and defaulted and the bank could not recover the money. Or there might be too many loans in your report showing that you've taken 10 loans, for example, as a company. Or it might also show that you've been fishing around or shopping around and asking for too many applications, making too many applications to too many banks for a loan. Now all these combine together into becoming a little bit of a negative for you, and that's why Banerjee company got rejected. So all this information that I talked about, loan amounts, late payments, written off, inquiries, number of loans, all that is contained in your credit report. And any of these would have caused the loan to be rejected. Now, so over time, as the introduction was said, I was one of the founding MDs of the first credit bureau in India at that time only, and people used to look at credit bureaus as an evil eye. They would say, oh, they are the bad guys, whereas actually it's not true. A good credit report, a good payment history, a good credit score is very good for you, because when you want more loans, when you want the bank to renew your credit, when you want lower interest rates, when you want to provide lower security, the best thing to do is to make sure that you have a good credit history, a good credit report, and therefore a good credit score. And we'll talk about that. But please, a bureau is not here to catch the negative guys. It's actually here to ultimately help the good guys. So, all this information is there in the credit bureau, as I mentioned. So your first question you probably should be asking, how did the bank get your credit report and who creates this credit report? So let's try and answer that particular question. So let's take a system again. Let's kind of put it graphically. When you first time you apply for a loan or you get a credit card, you submit the application to the bank, and the bank then decides to give you a loan. If the bank grants you the loan, you have to then pay monthly installments typically for your credit card on the due date, on your housing loan or your car loan, or you might have taken a working capital loan and therefore you have to pay interest every month, or you have to pay installments every quarter, whatever the structure is. So when you make these payments and every month, month 1, month 2, and it goes on, you keep paying it to the bank. Now when you do that, the bank shares this data with an entity called the credit bureau, and in the latter part of this section, I will talk to you about what is a credit bureau. But just accept it for the time being that the bank shares this information with the credit bureau. How much loan have you taken? Are you paying on time? What is your installment? If you're delayed, what is the extent of delay, etc. Now, let's say that after some time you apply for a second loan to another bank because you want to, buy some equipment, or you want to buy an office space, or you want to buy cars, or you want to buy some tractor, or whatever it might be. Now, when you apply to that second bank, before the bank considers you for a loan application, they will go to the credit bureau and say that Banerjee and company have applied to us for a loan. Please tell us what is the credit history and the credit report of this Banerjee company. And therefore, this credit bureau will now give a copy of the report that it has put together, and we'll talk about how it happens. They'll actually put this report together and give it to bank 2. And the bank 2 will look at this and decide, besides considering other factors, whether you should get a loan or not get a loan. So for example, if you've not been paying loans on time, you've been defaulting, there have been write-off loans and all, I mean, even if you were a banker, you'd probably say, why should I burn my fingers again by giving a loan to somebody who is incapable or who is unwilling to service that loan. Now, please remember one important thing here. The bureau is not telling the bank whether to lend money to you or not. The bureau is not opining on your credit worthiness. It is purely producing a report which shows how much you've taken and whether you paid your loans back, and if you haven't, then how late are you, how often late are you. That's all. It is for the bank to decide. So you never get rejected because of a bureau. You get rejected because your credit report from the bureau is not up to the mark of the bank. It is the bank that will decide whether to give you a loan or not. It is not the bureau, and that's very important. So all credit related information is shared between the banks and the credit bureaus. All the banks in India, and remember what I said in the beginning, when I say banks, I mean NBFCs. When I say banks, I mean housing finance, export, import, microfinance, new banks, cooperative banks, rural banks, and of course the nationalized banks and the foreign banks. All of them are members of the bureau, and all of them share all their information with the bureau. And every month, every week, every fortnight, the banks update that record so that when you make installments, it reflects positively, but if you don't, then it reflects negatively in the most current manner. So for example, many banks in India submit data to the bureau on a monthly basis. So typically around the 3rd or 4th of the month, they will extract the data from their system and and put it into the bureaus. So that's how the bureau gets your data. Now let's go back to the case study. If you remember Banerjee, who didn't get a loan, Banerjee Company, and Mishra and Company that got a loan. Now the credit report of Banerjee and Company had a negative information, and the loan was denied because of that. And the reason was that there was an unpaid, unserviced, delayed loan installments with the report of Banerjee Company. And therefore, you must always make sure you borrow within your capacity and you repay to avoid delays on non-payments. Repay on time. So what is negative information in the report? Typically, it is defaults, delayed payments, written off loans, settled loans. Any information that indicates bad credit behavior is not good. On the other side, Mishra and Company had a positive report. What does that mean? It means that whatever loans they've taken have always been paid on time. He's maintaining a good credit history, and there is no negative remark on your credit report. So typically, as we all know, negative information is negative information, bad defaults, delayed payments, etc. And positive information is where you made your loan payments and your loan installments always on time. Now, so we've talked about credit report, and we'll go to a little later in today's session. We'll talk about what a credit report contains. But let's go back to a very fundamental question: what is this animal, or what is this creature called credit bureaus? And the credit bureaus are entities that collect and store this information. Remember, we told you the banks supply data. So the banks supply data to an entity which is called a credit bureau. What does the credit bureau do? It collects all this and stores it in its database. For example, the Indian credit bureaus have millions and millions and millions of records of every borrower in the country. The credit bureau then processes this information and produces a credit report. So if I have taken a loan from 2 locations, the bureau, when somebody pulls a report on me, will collect these 2 loan details and put them into one report and show it to the person who has made the inquiry. At this stage, I'd also like to introduce to you that there are also value-added products like credit scores, and we'll talk about that in a separate section a little later, but I just thought I should mention it here. So, there is this credit bureau. Now what? Is your information safe? Because after all, these are your details about your lending and your, how much money you've taken and all some apparently confidential data. Not apparently, actually, it is confidential data. So the credit bureaus in India, and that's what matters to us, are actually licensed and regulated by the Reserve Bank of India. The RBI issues licenses without which you and I cannot start a bureau, and banks will not give data to you. These regulations, besides other things, ensure that your data is kept safe and you ensure that your data is kept private. So only a bank to whom you have applied for a loan or a credit card, here it comes again, the credit card, only a bank to whom you have applied for a loan or a credit card can access your credit report. Now please understand, this is very important. So it's not that anybody and everybody can access your report. Your data is very safe. The Bureau maintains very strong IT systems. It is checked by RBI, and RBI issues licenses and inspects them. And more importantly, only a bank to whom you apply can they pull a report. Of course, there's one more thing where you can pull your own report anytime. So while I as Satish Mehta cannot pull a report on you, but nothing stops me as Satish Mehta from pulling a report on myself, or nothing stops the proprietor or the owner of Mishra or Banerjee company to pull a report on his company. So who uses these credit bureaus? As I told you right up front, it is the banks. The banks get information about the individual or the entity or the SME or the MSME who is applied to them for a loan, and therefore they share data and then they pull data or they pull a report from the bureau. Now, current law very clearly said that all lending institutions have to be members of all credit bureaus. So any bank, any housing finance company, any microfinance bank, any microfinance company, just about any lender you can think of who is covered under credit and who is covered under the bank RBI is required to submit data to the bureaus, and they have to at least pull a report from one bureau when they are appraising an individual. How many bureaus are there? We'll come to that in a minute. There are 4, but I will answer that in more detail in the next couple of slides. Individuals like you and I can pull our respective reports, and as I said, that entities can pull their reports. And just for information from a legal perspective, insurance companies, telecom companies, credit rating agencies, etc., and that's the list that I put up there, are allowed to also pull reports. But in your context, important to remember, your bank will always pull a report when you apply for a loan. Your bank will always pull a report when you apply for increasing your limits. Your bank will always pull a report when they're reviewing their portfolio to see if there is any potential delinquencies or early warning signals that need to be identified and acted upon as they go forward. So, the million-dollar question, how many bureaus are there? There are 4. The first and the largest in India today, and that time it was the only one, was CIBIL, which is the Credit Information Bureau India Limited. I should tell you that this slide is a little old. It has now been renamed as TransUnion CIBIL, but that's more a technicality and from a legal perspective. Then there is Experian, there is Equifax, and there is CRIF Highmark. These are all internationally renowned technical companies who have come into India and within the gamut of law partnered with various local promoters to start these bureaus. CIBIL, as I said, was the first one, and we have 3 more after that. So remember, I told you one of the important things we'll talk about is what is not a credit bureau. So I must say up front, a credit bureau is not a rating agency. So CIBIL is not CRISIL, for example, and that's what I always get told when I was in CIBIL. Oh, you come from CRISIL. I said, no, I've not come from CRISIL, I've come from CIBIL. So a credit rating agency, and some of you have probably got yourselves rated from either any of the 4 or 5 rating agencies that we have. So what does the credit rating agency do? It provides an opinion on the future repayment capacity. Now this is important. It provides an opinion. It actually says that company A is likely to pay or not likely to pay. is provided in the form of ratings, as you know, AAA, BB, CCC, C plus, A plus, whatever. They're based, these ratings are based on various variables and various things that I consider. Things like balance sheet, profit and loss projections, promoters, regulatory environment, legal environment, export-import policy of the government, the dollar rate, anything could come in which will affect this. And the most important point is that a rating has to be initiated by the entity which is being rated. So I could not go and get a rating if I didn't want to. But if I go into a bank, the bank will probably tell me, go and get a rating and come. And examples of rating are, as I've written there, CRISIL, ICRA, CARE, India ratings, Brickwork ratings, and SMERA. On the other hand, let's look at what credit bureaus are in the context of what we just talked about. So a credit bureau does not opine. It doesn't say that this is good or bad. It just produces a snapshot. It just says, this is the history of the person. Is this history good, bad, worthy of loan, not worthy of loan? That is not the decision that the credit bureau is communicating to you. The output is provided in a report, as I told you, and as I said also, there is a score and there's a typical number. Now in India, that score ranges from 300 at the lowest to 900 at the highest. Don't ask me why, but that's the way it is. So the higher the score, the less likely that you are to default. And they only contain information on past payment. An important component here is that credit bureaus store it on all the entities' information. It's not created or generated only when an entity asks for a score. It's automatically created as soon as the bank receives an application from you. And as I said, the 4 bureaus in India are CIBIL, Equifax, Experian, and CRIFHIMA. Okay, at this stage, let's look at what are the details of a credit report. I think that's important. What is it that goes into the credit report? Now, this credit report sample that I'm putting up in the next few slides, there are 2 things to remember. One is that it is not the report of any one of the 4 bureaus in India, because we haven't done that. We've taken one sample and we've kind of tried to generalize it. But if you see similarities between what we put up and what is actually the report of one of the bureaus, it's purely a coincidence. The second thing to remember is that you will see 2 kinds of reports here. You will see the commercial report, which is the report of your entity, partnership firm, private limited, whatever. But it will also have the report of the individual consumer. So your report, for example, will also be pulled by the bank, although you technically have not applied for a loan. The loan application has come from your entity, but because as an MSME, you are so closely entwined or interconnected with the MSME that the bank will also pull your report. So let's look at credit reports here. What is a credit report? What are the types? Remember, I told you there are 2. What is the information that is there, and what should you remember as a key consideration with regard to your credit report? As I said a couple of slides before, and maybe right at the beginning, a credit report is a statement of your credit history. Very simple. It's a statement, your credit history. It gives details of all your loans and credit cards, remember. It gives details of all your loans and credit cards that you have taken in the past, whether you've serviced them, not serviced them, repaid them, they will still show up, and also any loans that you are currently repaying or servicing. And it also shows whether you're paying on time or not. And if you're not paying on time, it will show how late are you. 30 days, 60 days, 90 days, what is it? Because that severity of number of days you are late is an important component for the bank to know. Now, if I have a report, and I personally, for example, I've seen my report, I have a credit card, I have 2 credit cards, I have a housing loan and I have a car loan, but I have never defaulted. So my score is 853 when I last saw it about 6 months ago. And that's a fantastic score because the maximum, although nobody ever gets it, is 900. And therefore, I would be an imminent candidate to get a loan at a lower rate and better terms, and then get the bank to give me better terms. So that's what a credit report is all about. Now, as I said, there are 2 kinds of credit report. There is the individual or the consumer credit report, and that typically is pulled on you as an individual or your partner. It might be your friend, it might be your brother or brother-in-law, it might be your wife, whoever. And it is typically, it has data about your car loan, your personal and consumer loans, your home loans, and of course, your credit card. On the other hand, there is something called a commercial or a company credit report. Now that's what applies to your MSME entity. And this one is typically got data on your business loan, your working capital loan, your term loan, and and is therefore reflecting the servicing done or otherwise of the entity that you are going to go to the bank for a loan. Now, why am I putting up the consumer loan here when we're talking about awareness amongst the MSMEs? The reason is that because you're an MSME, because you are so, your life and your history is so intertwined with the MSME entity, that when the bank, when you apply to the bank for a loan, they will not only pull your entity's report and get a commercial consumer report, they get a commercial report, but they will also pull your report and get a consumer credit report. I hope I made myself clear. This is very important. And the reason I say it's important is because your credit card might be in your personal name. Now, if you don't pay that on time, it will show up on your consumer report. And your consumer report will be used by the bank and pulled and accessed by the bank before it analyzes the application from your entity. So one default in your credit card, which you think you can just forget about, would actually jeopardize your borrowing for your entity from the bank. So please remember this. So let's go back. A famous case study. You've got Banerjee and Company, which paid back all its loans, but Mr. Banerjee, in his personal capacity, had defaulted making payments. The entity is paying well, but he was defaulting. Now, I'm looking at this application and saying, should I give a loan? And the reason I would say no is because ultimately, if Mr. Banerjee has to pay the loan, I must be reasonably confident that not only does he have the willingness, but also the capacity to service my loan. And if I don't feel that way, I might refuse the loan, although Banerjee Company itself might not have done anything wrong. So, Mr. Banerjee's company loan will also be rejected because when the entity applies for a loan, the lender will check both the entity's credit report and the individual credit report of all directly related parties. Therefore, the loan officer will check Mr. Banerjee's individual report and he will be refused in spite of the fact that between his wife and his son, maybe they were earning lots of money. But Mr. Banerjee is the promoter, Mr. Banerjee is the owner of the MSME and is not paying on time. So it's extremely important that you maintain a good credit behavior, not only for your entity, but also for yourself. Okay, let's look at the individual reports. Let's look at the reports and see what they contain. Honestly, they don't contain anything fantastic or fabulously innovative or new. And when we go through it, you'll see. So, for example, let's take the individual report. And I told you why the individual report is important. The individual report in one section will contain your personal details. Name, date of birth, gender, PAN card, passport, voter ID, driver's license, ration card, Aadhaar card, whatever. Now, where did this information come from? From the banks. So all the gaps that you see is because the banks have not provided this information to the credit bureau. So tomorrow when you look at a report and you see this and you find something wrong, you say, but my PAN card is not this, it is that, and my date of birth is wrong. It's not the bureau's mistake. It's not a mistake, but wherever it is, it has to be corrected at the individual lending level. So you have to go back to the lender who supplied this data and get him to correct it, and in the next cycle, send it back to you. You then have the second sort of, not segment, but the second section of the report, which has all your credit facilities. So what will it have? It will have, for example, let's take a look. The member name, the account number, is it a joint ownership or a personal individual ownership? When was it opened? When was it closed? What has been the limit? What is the current balance outstanding? what is overdue, what interest rate do you charge on overdues, what is the term, what is the installment, and so on and so forth. The next piece of this has got the collateral details. So what is the security that you have given? And then you come to what is probably the most important, You come to what is probably the most important component of this section of the report, which shows your payment history. So if you look at this sheet, for example, it shows 000, which means that you are not past due date anytime in the month of November, October, September, August, etc. Standard means the same thing. But if you look at the bottom corner, second last number, in March 2009, you were delayed by 30 months. Now, is that a crime? No, it's not, for two reasons. One, because it's only a 30-day delay, not 30 months, sorry, 30-day delay, and it happened in 2009, and we are now in 2016. So 7 years have passed, and you've always been regular. So that's a good sign. You then have, and of course, if you have got multiple accounts or multiple borrowings, each of this data will repeat itself for each account. So this might be my housing loan data, the next one might be my car data, might be my credit card 1 data, might be my credit card 2 data. So it'll just keep repeating itself as a module. Now we move to the third section of the report, which is the inquiries. So this inquiry section lists any application. So remember, whenever you make an application for a loan, the bank will pull a report on you. Definitely. Okay, so if you apply to 10 different banks for the same loan, then there'll be 10 inquiries on you by each of the 10 banks, and that's not good, because it means two things. It either means that you're shopping around and not getting loans, or the banks are rejecting you, and therefore there is something wrong with your application. So too many inquiries are seen to be a little negative. All right. Okay. Now, included in the individual credit report is your credit score, and that's a number. And that number is derived by the bank through a complex list of algorithms that they have based on various things. It is based on your past history, your past payment, how much you borrowed, what is your expenses, etc. And that will throw up a credit score. And that score, as I said, in India ranges from a low of 300 to a high of 900. And it's an important decision maker for a lending institution when it decides to give you a loan. So here is one important piece of advice. Just before you're applying for a loan, get a copy of your own report. And a little later I'll tell you how you can do that also. So get a copy of your report and make sure that everything in there pertains to you, only you, and nobody else but you. Make sure that the data is absolutely and 100% correct and updated. So you'll obtain your report, check it. It's not very easy to obtain one. There is a small fee you have to pay. From next year onwards, the RBI has mandated that the bureaus have to give one free report for every individual once in a year. So you should get it. Make your payments regularly on your loans and your credit cards. Do not apply for credit outside your capacity. Do not make too many loan applications. Always ensure that the application you give is right, and if it needs to be updated, go back and update it with the bank. And also remember that being a co-applicant, being a guarantor, all these are negatives because they all reflect on your report, because you are then liable for the loan. So that's as far as individual reports go. As I said, in the normal course, when you're dealing with an entity applying for a loan, individual reports may or may not be relevant. But because you're an MSME, and in the MSME space, there is a lot of, as I said, intertwining and interrelationship between the MSME and the individual, your individual report becomes important. Now let's quickly run through the commercial report. Now basically the fundamental premise is not different. The fundamental premise is, again, information about the company, about the borrowings and inquiries. So for example, here is a company called Sample India Private Limited or Limited. It has a short form, it has various, where is it located, is it a private limited company, and some very basic demographic data is captured here. Then you have what is called a summary section, which shows, for example, in this case, that this entity, Sample India Private Limited, has got 5 credit facilities. As you can see in the center of the report, sorry, it's 3. As you can see in the center of the report, it has borrowed and closed one, and it has got 1 credit guarantor that it has given. And it shows at the bottom as a summary that as a borrower, there is a huge default, which is not standard in terms of payment, and therefore this is not a good sign, because over 2 crores is outstanding as a default with the bank, and that's why it's reported in its format to the RBI probably. So this is a summary section. We already talked about it. You then have what is called the relationship. Now, as you know, an entity has no identity of its own except the legality of its existence. So really, it is the people who own it. So those ownerships could be proprietary firms, it can be partnership firms, it can be partners, it can be private limited shareholders who are directors. And all these people have a relationship with the entity. And their details are also shared, and therefore this is called the relationship section of the report, where, for example, Mr. Sample individual is a promoted director, and this is his address, this is his PIN code, and this is where he lives, this is his report, and this is his telephone number, so that if the bank needs to, and it will, check his individual report, they will use this data to pull a report on Mr. Sample individual, for example. The second section is the credit facility account details section, and as I said, it contains all details year month on month on what kind of a loan have you taken, what is the outstanding amount, when did you take it, and are you defaulting or not, and if you are not, or if you are, then can they show in again the same way whether you on time or delayed payments when you look at the lower half of this particular sample sheet. And then, of course, the same inquiry section, where if you've made inquiries for your entity for loans, where did you make inquiries, for what purpose, and how often and when? Because again, too much of inquiry is seen to be not healthy. So, key considerations for the commercial credit report: make sure you only borrow as per your needs. That is, according to me, the commandment number 1 to 10. Ensure that all the information is accurate before you apply for a loan, because if it's not, it will throw up a wrong report which could negatively impact your borrowing. Make payments as per your due date. Always make payments, because late payments will show up in your report. Ensure that you and only other person related to the entity also maintains good credit behavior. So if your wife is a director or your son is a director, they might not be involved directly with the business, but make sure that they are paying their credit card or any loans they might have taken in their name on time. And of course, maintain a good credit history, which will make sure you get access to better and enhanced credit limits. I think as an MSME, that's probably your core importance. Get as much credit, get it as fast as possible, get it at the lowest rate possible, and get the best security requirements or the least security requirements, because I've paid my loans on time. So what's a credit score? Let's look at what is a credit score. Give me a minute, I'm just going to take a quick sip of water. So what is a credit score? What is considered to be a good credit score in India? And what is the impact of your payment behavior on your credit score? 3 typical questions and 3 very obvious questions that each of us should be asking when we keep hearing about credit scores. So a credit score is a number. It's a quantification of your overall credit worthiness. Now these sound big words, quantification, overall, credit worthiness, but when you break it down, it's a very simple thing. It's a number which tells the bank or the lender that what is the likelihood that you will default on a loan or not default on a loan. And what does it do? It takes your repayment history, it takes your total outstanding loans, it takes your secured versus unsecured loans and the number of inquiries, puts it together and throws up a behavior or an application score. And that score is different for different bureaus. So for example, the range is the same, 300 to 900. Now, your question you should be asking is that the same data is going to all the bureaus, absolutely the same, and if the range is 300 to 900, why is the score different? Now, when I say it's different, it's not because it's not different by 100 points. It might be different by 5 or 10 points. But yes, that could be different. Higher your score, the better chance that your application will get accepted. And as I said, when we were talking about rating agencies, a score is not a rating agency. A score is not a rating. It's a purely a number which tells the bank. Now the bank then decides whether that score is acceptable for it to give you a loan or not give you a loan. So a more aggressive bank, which is keen on booking more business, might have a lower tolerance and say, you know what, even at 650 or 600 will give us a loan. Whereas a very conservative bank, which is growing steadily and regularly, might say, you know what, we don't need this. We don't need anybody below 750. So that depends on the bank. And that's the other point I want to make, that the final decision to accept or reject a loan is completely with the lender. And therefore, you don't get rejected because Civil gave a bad score or Equifax gave a low score. You get rejected because that score, which is calculated based on your credit history, actually does not reflect well in terms of the bank's credit policy or risk appetite. So what is considered to be a good score? Here it is. Typically in India, anything at about 750 is considered to be a good score. As I said, a bank might reject you at 750 or higher. A bank might accept you at 750 or lower. So let's look at what happens, and I hope you guys can see these numbers, but let's see what happens. So if you look at this, there is days, the DPD means days past due. So in Mr. Banerjee, remember our friend Mr. Banerjee who was defaulting on his personal loan? Well, if you look at it, from January 2014 on the right hand side of the sheet to December 2014, there was a period when he didn't pay on time. All right, and I don't know, the numbers are not showing up because of the red color. But in June he was 30 days late. July he was 60 days late. August he was 90 days late. September he was 120 days late. October he was 150 days late. And then in October he realized and therefore came back and made all the payments, and therefore in November, December he's again on track. Now look at his score. As long as he was paying on time, his score was steadily increasing. 700, 720, 720, 740, 750 also. Very good score. Now as he started defaulting, his score started falling. 680, then 650, 610, 600, 560. It really fell because the extent of his default increased from 30 days to 60 days to 90 days to 120 days. Now in November or October when he made the payment, again his score is beginning to creep up. 560 has gone to 570. Now the reason I use the word creep up is because he has to undo his bad credit history, and that doesn't get undone within 1 month. So whilst it takes very little time for the score to crash because you've not paid on time, it takes longer to bring the score back to normalcy. So that's something you've got to remember, that just because you clear your loans doesn't mean that automatically you're going to be fine on your credit report or your credit score immediately. Yes, it will start improving, but there are many other factors that come into play also. What I was saying, as soon as he started defaulting, his score dropped significantly, but just because he clears dues, it doesn't mean that there was only a minor improvement. It takes time. So building a good credit score is a matter of time. Late payments and defaults can easily have a negative impact, but rebuilding it can take even longer. Again, another reason why you should make a conscious effort to maintain a good credit score. Because you might say, I don't want to borrow just now, but at some stage the bank will be reviewing your limits, which happens every year or every 2 years. At some stage the bank might review the interest rate, and some of the factors that it will consider is what is your credit report, what is your credit history, what is your credit score. So it's always good to have good scores and good reports. Points to remember, as I said, a higher score means low probability of default. That's good. A high score will improve your chances of getting better terms. Low interest rate, longer term, larger amount, lower security. banks do use scores to decide on your credit. Key elements that impact your score, as I told you, are payment history, too many inquiries, outstanding loans, delayed loans, etc. Different banks will interpret the score differently. Like I told you, an aggressive bank might say 650 is a good score, but a very conservative bank might want 750. Incorrect information can impact your score. So, for example, if somebody else's report or data has got into your report and he has not paid on time, it can affect your score. Now, why would that happen? And if it does, what is the remedy that you need to do is what we're going to discuss in the next session, which is called, unfortunately, the dispute resolution process. But basically, if your data is incorrect or if your data is not being updated, then we will discuss what you can do, and you can do a lot. So now we're going to talk about the dispute resolution process. In this section, we'll say what is that process and how does it work for you. So Mr. Banerjee's loan, my friend Mr. Banerjee's loan got rejected, but what if that information was wrong? What if it did not even belong to him and belonged to some other Mr. Banerjee, which by mistake got in here? Is that possible? Yes, it is. As you know, in India, there are different, if you look at Banerjee is an extremely common East Indian name. If you go to Gujarat, for example, you'll find Mehtas, Shahs and Patels. If you go to Punjab, you'll find Singhs. If you go down south, you might find a lot of common surnames or common family names, which can lead to wrong data or somebody else's data coming into your report. Because in India, we've just started trying to get a unique number like the Aadhaar card, but then there is Aadhaar, there is PAN, there is voter ID, there is passport number, all kinds of things. And sometimes the quality of data that the banks capture is very poor. Now remember, when the data is bad, it is not the fault of the bureau. The data has been given to the bureau by the bank. The bank owns the data, and therefore the bank decides the quality of data. Those of you who studied technology will remember a very famous phrase which was taught to us right at the beginning, which is that garbage in is garbage out. So if you put wrong data into the bureau, wrong data will come out, because the bureau will not correct your data. If you find a mistake, there is a way to go about doing it, which I'm going to talk about now. But I can tell you here, it is the way to go about doing it is you can write to the bureau, you can write to the bank who has made the error, but the bureau will not correct the data. The bureau will write to the bank from where the original wrong data came from. The bank will then verify whether that data is right or wrong. If it is wrong, they will correct it and send an update to the bureau, and the bureau will update that record. So, let's look at this case study. The consumer, you, me, individual, company is extremely important, because ultimately it is us who get affected by the existence of a bureau. All borrowers therefore have a right, and you and I have a right, to raise a dispute in case you think there is wrong information in the report that you've collected. So how does it work? All credit bureaus have a dispute resolution process in place. If you go to the website, you will see it of all these bureaus. You may alert the bureau for an error. So you can tell the bureau, Mr. Bureau, this is not my account, or my PAN card number is wrong, or this address doesn't belong to me, or I never made so many inquiries. They will then contact the banks regarding the erroneous data, and that will be marked as a dispute until the issue is resolved. And the bank will then either say, yes, we made a mistake, here is the correct data, or they will say, no, we have verified this data, and actually it is Mr. Satish Mehta who has got this loan and therefore is defaulting. I could be trying to find a way to remove it from my report also. So if you remember, I told you in the beginning that the RBI actually regulates credit bureaus, and therefore they have specified that the bureau has to take up within 30 days and resolve the data, the dispute that is there. And as I said, the bureau cannot change the data. It is for the bank that provides the data to do a change if required, if it is found that it is actually a mistake. There are a few credit counseling companies which can help you in that process also. Key points to remember, and we're coming very quickly to the end of this presentation, a little ahead of schedule, but that's fine. I hope I'll give us a better chance to ask questions. we're going to discuss or summarize what we've talked about the last 1.5 hours. What is bad credit practice? What are the consequences? What is good credit practice and what are the benefits? And what should you remember from this session that we have had? So bad practices from credit is borrowing too much in relation to your needs, borrowing too much in relation to your ability to pay. The consequences are that you will be over indebted and you will sharply increase your liabilities and will dramatically affect your cash flows. The other bad practice besides borrowing too much is after borrowing not paying on time. If you don't pay those installments on time, you'll be charged interest and you will further get your cash flows get affected. Now, you don't pay on time or you pay therefore past the due date, it will show up in your credit report and that will definitely impact any future loan that you're trying to get or any renewal or any lower interest rate you want to benefit from. And of course, making too many loan applications is bad. All these bad practices will ultimately restrict your access to finance. But like I said, credit bureaus are not about bad practices. Credit bureaus are actually about good practices. So let's talk about the good practices. First thing, be clear of what you want the loan for. I had people coming and say, oh, I've got 7 credit cards. So I said, what do you do with 7 credit cards? I said, no, I just feel good about having 7 credit cards. Now that's crazy. You don't need 7 credit cards. Most of us don't. So be clear why you're borrowing, whether it's for your business, for your working capital. If your working capital requirements are, say, 10 lakh rupees, don't go and apply for 25, 30, 40 lakhs. Apply for 10 because that's what you want. And you can always go back asking for more. Apply for loans that match your needs. Ensure that you borrow and you can always repay on time. Check your credit report from time to time and your score before you make an application to see if there's an erroneous report or erroneous data in your report. And if there is, please, please go ahead. Talk to the bureau, talk to the bank and get the dispute resolved. And always pay your loan installments in full and always pay them on time. The benefits, and this is something that I want to leave you with. I'm telling you this again and again that the credit bureau is only for your benefit. The benefit will be that your credit report will be positive. Loans from different lenders will be easily available to you. Lenders may offer you better terms for good behavior. You may get lower collateral requirements, lower margin requirements. This will help you expand your business and grow your business and improve your income and your revenues. And therefore, your business will always get ready access to finance whenever you need. So good credit history or a good credit score is always equal to better access to finance. Very important. On the last slide, I want to highlight the 4 takeaways from this session. Every time you apply for a loan, the bank will obtain your credit report. It's not a choice. The bank will obtain it. A credit card, even in your personal capacity, is an important form of credit and affects your history and your report and your score. You and your entity, especially because you're an MSME, are linked. Your individual report will also affect your entity's creditworthiness. And becoming a guarantor or a co-applicant to a loan also affects your credit report. So these 4 points, ladies and gentlemen, whoever is listening in, is very important. And that's what I wanted to end this session with. We finished about 10-15 minutes ahead of schedule. I'm happy to answer any questions that any of you might have posted. And if there are any other queries, of course, please feel free to send an email and I will get forwarded that and we'll see what happens after that.